tax considerations for selling a business and often a medical practice. Allocation of the purchase price. This is something that I have a lot of questions on. Of course, many of my clients have businesses that they sell. Many of them are medical professionals, so they're selling their medical practice. But this applies to pretty much any business. And this allocation of purchase price is a little understood issue and complication and wrinkle that you really do need to understand if you're selling your business, because it's part of the negotiation. Because the IRS requires that the purchase price be allocated between all the various types of assets. And the allocation has to match. So the buyer and the seller are both going to create an allocation schedule and they have to match. So it's one schedule for both. So you as the buyer can't say, oh, I'm allocating it all to, 5-year property that I can bonus depreciate. And as the seller, you're allocating it all to goodwill so that you can get capital gains treatment. You have to match it, which means that the tax considerations are opposing ends. In other words, they're at tension. The buyer and the seller really do have the opposite interests when it comes to allocating the purchase price. So it's your job as the seller of the business, or if you're the buyer, as the buyer of the business, to make sure you understand, okay, if I agree to this purchase price for the sale, how is this going to affect the tax implications? And the negotiation of the allocation is part of the negotiation of the sale. And if you don't understand that, you're going to negotiate the sale price and then you're going to try to allocate. And then you're going to realize, oh, I'm getting a lot less money because I'm paying a lot more in taxes than I would had I allocated it a different way. So let's get into it. So two doctors could sell their same practice and actually get the same purchase price. So let's say it's $5 million. So both doctors sell their business for $5 million, but they allocate the purchase price differently. One of them could end up with $4 million of after-tax money, and the other one could end up with $3 million of after-tax money just on the allocation differences. So it can make a huge difference between what you actually take home when you sell a business. So in this video, I'm going to walk you through the considerations, what the various categories are for allocating a purchase price and how that allocation works and what the considerations are and what the negotiating points are. So first of all, people say, well, why does the IRS care? I mean, purchase price is the same. The IRS cares because the IRS has to deal with you both individually as taxpayers. So if you allocate it one way, you get the most tax advantages, and the seller allocates it another way, and they maximize their tax advantages. Who gets cut out? The IRS. And I can promise you the IRS never likes to be cut out of a deal. So IRS cares a great deal, which is why the IRS requires you to both submit allocations that match. In other words, you're going to submit one matching allocation for the purchase price. That's not negotiable. The submission, what's negotiable is how the allocation is actually divided. So what are the big differences? Well, certain allocations are going to be treated as ordinary income or recaptured income for the seller of a business. For example, if there's a building in the business and it's part of the sale and the buyer has fully depreciated the building, and particularly if they have accelerated the depreciation, then allocation of purchase price towards building is going to likely trigger a recapture of that accelerated depreciation. That ends up as ordinary income for the seller. And ordinary income is the highest tax rate when we're talking about this type of transaction. Ordinary income is going to be 37.5 or whatever the top tax bracket is or whatever bracket you fall into. The other type of allocation is to something that is going to trigger a capital gain. So, for example, if you buy a stock, let's say you buy Apple stock and you buy it at $150 and you sell it for $200, and that gain is a capital gain. And capital gains tax rates are much lower, like 20%. So would you rather pay 20% on your gain or 37.5? And so that's the big distinction. And that's where the fight comes down, because the more you allocate towards an asset that is going to end up as ordinary income tax rates for you as the seller, the less advantageous it is, which means you should be asking for a higher purchase price. So the answer is if the buyer is more concerned about the allocation, and you just want to get to a net number, you can say, well, great, I'll allocate it however you want to allocate it. But I'm going to do the math, or I'm going to have my CPA do the math. And once that math is done, I'm going to set the purchase price based on the net that I'm going to receive. And so that's a very, very important thing to understand. Most often, sellers are focused on the sales price, and buyers are usually focused on the allocation, the payment terms. And so often what happens is that a buyer will agree to a sales price that makes the seller happy, but they've got it in mind that they're going to allocate a certain way that's far more advantageous to them. And many times sellers don't even understand that this allocation is going to affect their bottom line, and they let it happen and they just allocate however the buyer wants to allocate. And they end up getting a lot less of that total sales price than they would have had the allocation been more favorable to them. Proactive planning when selling a business is probably one of the areas that is most advantageous, and it is complicated. This is not something for an amateur to do. While I'm a tax attorney, it's not an area I practice in every day. I understand it, but I can tell you when I have a client with a complicated transaction for the sale of a business, I'm going to bring in the best accountant that I can possibly find. It is not something that you just want to wing. And with a little bit of advance notice, sometimes a year or two, you can make a massive difference in the net effect of a sale. So, if you are in the market at all for selling your business, whether it's a medical practice and it's just making $1 million a year, or whether it's a huge company making $100 million a year, advanced planning can make all the difference. And I have seen some truly brilliant tax plans that have saved clients really tens of millions of dollars. I have seen some botched plans where really there was no plan, and the net effect is that seller of the business just paid maximum freight. In other words, they got a reasonable price for the sale, but they really didn't take home what they should have taken home. So advanced planning is critical. So let's break down the different actual categories of assets that you can allocate to. So you've got tangible assets, things that are physical, could be equipment, could be an office building, etc. You've got intangible assets, which is things like intellectual property. You have goodwill, which is effectively an intangible asset. Could be even be a non-compete agreement. That certain amount of of the purchase price is allocated to you, not going back into the same type of business. Could be patient records, could be patents or copyrights. All those things matter, and they all get a little bit different tax treatment. The biggest one, which we already mentioned, is tangible assets. So the building is the most common one. You will often see a client selling a practice and also sell the building with the practice. And the building is the biggest tangible asset. It's probably had the most depreciation. It's probably fully depreciated if they've owned it for any amount of time. And the net effect is that if you allocate a lot to the building, then you're going to have a greater likelihood that we have to recapture depreciation. So what is recapture depreciation? Recapture depreciation is an interesting concept. Basically, when the IRS says that you can depreciate an asset, they are saying we know this asset is going to wear out. And so we're going to give you an imaginary deduction for the amount of the value of the asset that we consider is wearing out. So for a building, it could be 27 and a half years for residential or 30 something years for commercial. And that means you're just, maybe you're deducting 3% of the value of the business each year. So not very big. However, the IRS also gives you something called accelerated depreciation. And what accelerated depreciation is it's depreciating the asset faster than you're actually using the asset. And so today, in particular, as I record this, we now have permanent bonus depreciation. And bonus depreciation allows you to depreciate an asset, even an asset like real estate, much faster. This gets into the concept of doing a cost segregation analysis, which means you're segregating the cost of the various components of a building, and anything that comes in at less than 20-year property, per the definition of the IRS, can be written off in year one, the whole amount. So if you purchase a building, let's say for $1 million, it is not inconceivable or even uncommon to deduct $250,000 or $300,000 right away in year one. That's kind of amazing. And that means that really your entire down payment, which might be the same, $250,000 to $300,000, could be deducted in year one. That means that effectively the IRS is really giving you a huge hedge when you're buying an asset that can be depreciated. That's great. And that can be a tax planning in and of its own right, where you actually buy buildings and depreciate them accelerated to offset ordinary income. And if you meet the rules and dot the I's and cross the T's, this can be a fabulous tax plan. However, when you go to sell that asset, if you have depreciated it faster than its normal schedule, the IRS says, hey, you have to recapture some of that depreciation. And since you were able to offset ordinary income when you first depreciated it, we're going to require you to acknowledge it or categorize it as ordinary income as you bring it back in. And as we said, ordinary income typically has the highest tax rate. So that's not good for you. So those are the assets that you have to be most careful with. It also applies to things like equipment. So if you're in a medical practice or a dental practice and you have, let's say, $400,000 or $500,000 of equipment that you've depreciated, particularly if you've taken bonus depreciation or accelerated it in any way, that depreciation could be recast as recapture, which means ordinary income. Again, this is okay. This is not wrong, and you're not wrong to have taken the accelerated depreciation. It's just something you have to consider when you're determining your purchase price. The other type of asset is a more intangible asset, and probably the big one that most businesses, and particularly like a medical practice would have, is goodwill. And what goodwill is goodwill of your name. In other words, it's the value of your brand. Do people, when they think of ABC Dental, do they think of, wow, that's a great place. We've got lots of referrals. We've got lots of, goodwill into the community. People recognize the name. We've sponsored Little League for the last 15 years. Everybody knows who we are. And we've got clients and patients coming in off the street because they recognize us. When a buyer buys your business, particularly a medical practice or a services practice like that, much of what they're buying is goodwill. They're actually buying the goodwill of the practice. So why would you want goodwill to be allocated at a greater rate than perhaps a tangible asset like a building or equipment? Because goodwill is not subject to recapture, which means that you are just going to pay capital gains on the goodwill. So your basis in the goodwill might be zero, but you're only going to be paying 15 or 20% gains tax on the goodwill allocation. And since much of the business is really, truly goodwill, that's really what you're selling, then that is a reasonable thing for a seller of a business to request, is that a large portion of the sales price be allocated to goodwill. This is going to be the biggest negotiating point because, of course, for the buyer, they don't want it allocated to goodwill because then they have to amortize that slower. They would rather have it to something tangible. And so that's where the tension comes in. And that's where you're going to have to negotiate and understand the benefits and the downsides of those allocations to you as the seller. So patient records. Often when you're selling a medical practice, people think in terms of the patient records. Well, first of all, you have to understand patient records are subject to HIPAA rules and all sorts of regulations. They are also not separately line item out. It's part of the goodwill. So don't think of patient records as a separate line item on the IRS form. Think of them as part of the entire goodwill calculation. So when you think goodwill, you think the value of the name, the good name, and all the existing patients and their referral power and their continuing revenue to you as they come back to continue to see the practice. So just know the patient records are really rolled up in part of goodwill when we're thinking about the tax allocation from the standpoint of selling the business. How about a non-compete agreement? Often when you sell a practice, the buyer wants you to not set up shop next door. And then, of course, all your patients know you and all your clients know you, and they're just going to go to you. So it's reasonable for a buyer of a business to say, hey, you can't set up shop within 15 miles and just, get back all your previous customers or patients. So a non-compete is often included in a sale. However, how is it treated? Well, a non-compete, you're effectively being paid not to work or not to compete. IRS sees that as ordinary income. It is not part of the goodwill. It's a separate agreement. It has a separate line item listing. So you do not really, as the seller of the business, want to have a lot of allocation to the non-compete because you're going to pay ordinary income tax on that amount. The other thing to know about non-competes is that the courts have really consistently come down more in the last few years very negatively towards non-competes. In other words, they really don't like them at all. They feel like they are impeding the trade, they're impeding business. So with very limited exceptions, you have to be careful if a non-compete is even enforceable. So I would say that, it's okay to sign a non-compete or have a non-compete. I wouldn't allocate a lot to it if you're the seller of the business. If you're the buyer, of course, you want a lot of allocation to it because you can deduct it much faster. But the reality is just be careful. Anytime you start to see non-competes, it's a slippery slope around how enforceable they are, and of course, as the seller of a business, they're least advantageous from a tax standpoint. So if you're listening to this and you're saying, this actually applies to me, and wondering, really, okay, once I sell my business, not only do I need to have tax planning, but what am I going to do with these assets and how am I going to protect them? Then I would really encourage you to take our short 7-minute quiz on how your assets are protected. There's a link below. You can access it. What I found is that when clients sell their primary cash generating business, oftentimes their first thought is, oh, wow, I'm out of all the risk. I'm no longer practicing medicine or I'm no longer doing business. I can just forget about asset protection. What I found is actually the opposite is true. Once you can no longer make the money back, in other words, you've sold your cash cow, you've sold your business, your practice, getting that money replaced, should you lose it, is going to be that much more difficult. It's even more important to protect your assets. When you get to that phase of life where your assets are now the only thing generating income for you, you need to protect them more than ever. So, a liquidation event, a liquidity event like selling your business is the ideal time if you have not already protected your assets to protect your assets. That is the perfect time, particularly since that's also likely the largest amount of cash you've ever had directly. In other words, if you sell your business for $10 million, that's usually the largest transaction you've had. And so that's the most amount of money you've gotten in one chunk. And again, it kind of changes the game. And I find it is critical. That is the moment you want to be most thinking about, how do I preserve my assets, both legally in the form of setting up a asset protection plan, but also, how do I invest this properly? And that's a whole nother conversation, but just as important to think about. So, is the allocation a big point in the negotiation? The answer is yes, it really is. You need to, when you're creating your first letter of intent to buy or sell a business, you need to include a proposed allocation right in the letter of intent. That is critical because that sets right out front that this is part of the negotiation process, that we're not forgetting about this. I'm going to leave it to after the fact. Otherwise, what happens is nobody thinks about it, or only one side's thinking about it and planning for it, and the other side is ignorant of it. And then when it comes time and the other side gets the allocation and their CPA says, hey, you know how bad this is for you, then we're right back to the negotiating table. So if you are going to sell or you're going to buy a business, in your LOI, make sure that a proposed allocation of the purchase price is set forth. Remember, for the buyer, it's less important than it is for the seller in many ways, because a lot of the assets, whether it's a non-compete or whether it's goodwill, they're going to get 15-year straight line amortization without bonus depreciation. So there's no real big difference for them there. While it is a big difference for you, so you'd much rather have it allocated to goodwill and not to the non-compete. On the other hand, the buyer might want to allocate enough to the non-compete to make it enforceable, which is why that enforceability issue is actually a real issue. So for them, it's less about the taxability or the tax treatment for the buyer, but more about the fact that they really do want to enforce the non-compete. And if they don't allocate enough to it, then the judge could look at it and say, hey, you really didn't pay for this, so you shouldn't expect it. So again, set it out in the beginning. Make these deal points something that you already are putting on the table so that you and your attorneys can address them in the beginning when you're first talking about purchase price and overall deal structure, and don't wait till the end. The other thing to understand is that the allocation cannot be ridiculous. In other words, you can't allocate to the building a price that is half the value of the actual building. It's not just whatever you want. You have to allocate it in a reasonable way. So if the building has an appraisal and it's worth $3 million, then you need to allocate $3 million. or very close to it. You're not going to be able to say, "Oh, well, I negotiated with the seller. He's going to just pay 2 million for the building." The IRS will jump in and they'll have something to say about that. So really, those type of assets, particularly a building, if it's included, is something that you really need to look at what's the actual value of the building when you're determining the allocation. The other thing to understand is that usually the building and the business are going to be two separate transactions. If you're structured properly, your building is not in your business. It's in a separate LLC underneath your holding company and protected by your bridge trust. That way, you're leasing it back to your business. So if they want to buy the business, great. If they want to then be a tenant and you be a landlord in the building, great. If they want to buy the building, it's not part of the allocation process for the purchase price of the business. It's just a separate transaction, treated separately. And that's the way most of the time it's going to come down. Where we might get into the tangible assets with recapture are equipment inside of the business, particularly if you have, let's say, trucks or a fleet of trucks, or very expensive equipment. If you're a manufacturing business or something where you have a lot of equipment that's actually inside the business itself, and then the buyer is going to be buying that equipment, and most of the time, equipment has been depreciated. The depreciation schedule for equipment is much faster than for real estate. So by the time most sellers are selling a business, there's zero basis in that equipment. So that's going to be a deal point. And again, if it's a medical practice and you just have maybe $100 or $200,000 worth of equipment, it's probably no big deal. But if it's another type of business where equipment is more relevant, like a contractor or construction company where you might have a lot of equipment, then it could be a very big deal. So again, get it into the deal structure right at the LOI stage. Don't wait till you've already chosen a price. Your price should always be really the last thing you get to when you're backing into what is this business worth, because it's the entire structure first and then back into the purchase price. And then it all goes on the same LOI so that everybody can be negotiating from the same piece of paper. If you're a medical professional and you are selling your business, just understand that yours is actually one of the areas where the allocation can make the biggest difference. Often your purchase price is not in the tens of millions of dollars, but it's in the a couple of $3 or $4 million. So allocation could be huge when it comes to how much you actually take home. It should not be a footnote in your negotiation. Should be something that you discuss and understand. And frankly, before you even set the price you're asking, you should have the allocation laid out the way you want it. So that when someone comes to buy your practice, you're actually telling them, this is what I'm asking for it, and this is the allocation. This is what you would actually be buying. You're going to buy my goodwill. You're going to buy my non-compete allocated to this, and you're going to buy these tangible assets. That way, the buyer has a clear roadmap to exactly what to expect, and then they can make their calculations, and you guys can get to a fair price based on facts, not on imagination. Don't assume anything is tax efficient without your tax professional getting involved. If your CPA is not the type of CPA that understands the sale of a business, it is okay, and in fact recommended, that you hire a CPA specifically for that transaction. It doesn't mean you're firing your CPA or they can't do your taxes. It just means that for that transaction, you need a professional. You need someone who's very familiar with buying and selling businesses. A good CPA is going to welcome that. They're not going to want to take on something that they're not comfortable with. So I would very much encourage you to see the right person for the job and look for the right person for the job, not just assume that your CPA is up for it. If you're a client of mine already and you are in this position, you should call me. I am very familiar with these rules. Again, not my practice area. I am still going to refer you to your CPA so that they can actually do the allocation and the calculation of what the tax impact is going to be. But I would strongly encourage you, because there are other considerations and legal considerations when selling a business. For example, one of the biggest things I see is, are you selling the shares of the entity or are you selling the assets? This is a huge distinction. Most people just don't understand it. But most buyers are not going to want to buy the shares of the business itself. In other words, the interest in the company. So let's say your company is set up as an LLC. A buyer could theoretically buy the LLC. That would be great for the seller, by the way, because then it's just going to be capital gains treatment pretty much all the way through. However, for the buyer, you're now buying the business, but you're also buying all the liability that's associated with that business. So could be tax filings, could be self-employment tax filings that you've made over the years, could be liabilities, it could be any type of hanging issue that is attached to the company. If someone buys the company, they're buying all those hanging issues. Most of the time, buyers are not interested. They just want the assets. And so almost always a sale is going to be structured as an asset sale. When it's an asset sale, again, that's when the allocation becomes really important because you're allocating per each asset what the purchase price is for. The buyer is not taking over your business structure, whether it's an LLC or corporation, C corp or S corp. They're not taking all that over. There are a few instances where the buyer is willing to buy the actual company. And I see this most often when sellers have special licensing or approval that is very difficult to get, and it's attached to the company. So let's say you're an approved vendor for the US government and your company has the authority to have bids for military contracts. A buyer is going to want to buy the company because they also want to buy that pre-approved status that the company has. In that case, it's different. And again, that's a value in and of itself. So the company has a value, and then the liability is much more acceptable to take that risk. I can tell you the due diligence around that kind of transaction is going to be much greater because the buyer is going to need to feel very comfortable that they're not taking on some massive liability that you didn't disclose to them. The other thing to know about selling a business is that I cannot tell you how many times I have seen my clients sell a business only to have the buyer come back 1 or 2 or 3 years later and not want to finish paying for the business or even ask for the money back. And the reason is that it's very easy for a buyer of a business to sue a seller after the fact because they get in there and of course they're going to find stuff. They're going to find things that they didn't really understand in their due diligence. There was no way for them. And they're going to feel like, oh gosh, this was misrepresented. Most often it was not misrepresented at all. It was just something that they were unfamiliar with. They didn't understand this about this practice area or about this business. And so they're surprised. Or they go in and they think they know how to run a business and they actually don't know the peculiar nature of that business. And so they end up not doing as well as the seller was doing. And they assume that that's because the seller somehow misrepresented something. And so what I tell my clients when they're the seller of a business, if you're the seller of a business, that business, you need to give them all the due diligence. You need to be really clear about any kind of representations you're making, any kind of warranties. Really, you should be making no warranties. You should be very clear that these are the facts, that you are representing that the information that you're giving them, usually the financials, the receivables, lists of inventory, things like that are accurate, but do not make representations about what the business can do in the future and anything that they could use later to say, hey, you misrepresented this. It should be an as is, where is type of sale with no warranties or representations about anything. That alone does not get the seller off the hook. The seller is still on the hook because there's this little thing called fraud. And fraud cannot be waived. So you can't waive fraud. So somebody could say, hey, waive all of your claims to me. If you're going to buy this business, you have to waive everything. They can sign that and waive everything. But if later they come and accuse you of fraud, that waivers does not apply because you can't waive fraud. That's the trick. That's how people, in particular buyers, come back to sellers and say, hey, and they almost always assert that the seller made a fraudulent claim or didn't disclose something that they should have disclosed, that they knew about or should have known about. And this is a huge issue because sellers have very little defense to this. It's very hard after the fact. And the reality is that most of the time when I see this, it's really the attempt of the buyer to not finish paying for whatever they bought. So what I tell my clients who are sellers of the business, if you are happy with the cash that you're receiving in the initial down payment, whether it's 50%, 75%, 80%, 90%, whatever it is, if you would sell it for that, and even if you weren't going to get the other 20%. Let's say you get 80% up front and 20% you're supposed to get over 2 or 3 years. If you're happy with the 80%, go ahead and make the deal. If you're not happy, if you are really not happy and that's not an acceptable price to you, reconsider selling it. Because I can't even tell you how often it is that the buyers come back, assert a fraud claim, put the sellers on their heels, and now the sellers have to do a math problem. And effectively, the problem is it worth fighting this to try to collect my 20%? That's lawyers. It's years in court. There's still no guarantee that I'm going to win. They're now running the business, so they control everything. They control the narrative. And, what they're really asking for, they're asking for two things. We don't want to pay you what we owe you, and we want you to give us all our money back. What they really want is just to not pay what they owe. They don't really want all their money back. They just don't want to finish paying for it. And so where they settle is, okay, you know what? We're not going to pay you anymore. You're not going to give us anything back. We both walk away. For the buyer, that's a win. They basically negotiated a price and then only paid a percentage of the price. For the seller, I would call that a lose, unless, again, you're already happy with what they already paid you. So be very, very, very careful when you're selling a business. It is a very risky time in any entrepreneur's life. I consider it the greatest risk point, which is another reason why when you do have that liquidity event, when you sell your business or your practice, that's the time for asset protection. Because not only do you now really need to hang on to the money that you have because it's what's generating your future income, but you now have a buyer that is a potential creditor. And so I always encourage clients that call me and say, "Hey, I'm selling my business. Do I need to keep my asset protection plan?" 1,000% yes, you need to keep it now more than ever. And clients who call me who have not yet done a plan and say, "I'm in the middle of selling my business. Now I'm going to have all this cash. Should I do asset protection?" The answer is 1,000% yes, you should do asset protection. Then more than ever before. So that's my 2 cents on buying and selling a business based on a lot of years of experience and seeing literally hundreds of transactions from clients and how they've gone right, and how they've gone wrong. So if you are considering selling your business and any of this sounds like music to your ears or something you need to understand more about, I invite you to do an analysis with my firm. You can click the link below. That will give you an opportunity to schedule with us. We can discuss all of these things as well as how do you actually protect your money once you actually finish the transaction. It is incredibly important. This is not something to wait on. If you are going to do asset protection, I strongly recommend you do it before you complete the sale transaction, if at all possible. There are legal reasons for that. Instead of doing it after the fact, it's much better to do it before the fact. In fact, most of the time, it's always better for asset protection to be put in place sooner rather than later. So I hope this has been helpful. And remember, it's your money. Act like it.